Many people ask me the real secret to building massive wealth, and I always tell them the exact truth, but nobody wants to believe it. They prefer the flashy lies and the fake gurus selling overnight Lamborghinis, while the real money is made by being incredibly boring and unimaginably patient. Right now, the global financial matrix just experienced a massive structural shift that is going to completely dictate the path of your portfolio for the next decade. It is officially a done deal because the United States Senate just narrowly confirmed a brand new chairman at the Federal Reserve Bank. His name is Kevin Warsh, and he was specifically handpicked by President Trump to run the single most powerful monetary machine on the face of the earth. The entire global economy and institutional Wall Street are watching this transition with absolute anxiety because the stakes have never been mathematically higher. This man is stepping into a historical trap where he must choose between two catastrophic paths for our financial ecosystem. He is either going to aggressively print money to artificially pump the stock market and risk completely breaking the purchasing power of the United States dollar, or he is going to stand his ground to save the dollar from hyperinflation and risk triggering a massive systemic freeze across the entire corporate economy. The truly fascinating part of this situation is that we are already witnessing immediate high-level friction between President Trump and his new central bank chief. Before Kevin Warsh was officially confirmed to take over the corner office at the central bank, the White House made its explicit expectations entirely clear to the public. The administration openly stated that they had no intention of appointing any individual who would refuse to execute their exact economic vision. The executive branch wants massive interest rate cuts down to a target of roughly 1% to ensure America has the cheapest borrowing costs in the developed world. They want a continuous wave of monetary stimulus and debt expansion, because that specific behavior immediately pumps asset prices and makes the stock market look fantastic on television. But on his literal first week on the job, Kevin Warsh stood directly in front of the Senate Banking Committee and dropped an absolute bombshell statement. He looked the lawmakers in the eye and explicitly stated that he will absolutely not be the president's sock puppet and that the Fed will remain strictly independent. Let us strip away the fancy vocabulary and look at the actual reality of this institution, because the average person is completely misled by the marketing. Even though the organization is officially named the Federal Reserve Bank, you need to realize it is not actually a normal bank. You and I cannot walk through their front doors to open a checking account or deposit a single hard-earned dollar. It is also not an actual reserve because the system is not sitting on a vault of physical cash reserves to back up the monetary base. And it is absolutely not truly federal because it operates entirely as its own distinct private entity outside the typical boundaries of the three branches of government. The fundamental reason the creators structured the central bank with this level of independent insulation is simple math and human psychology. Every single political leader in human history naturally wants a booming stock market and endless economic stimulus during their active term in office. But the true structural job of the Federal Reserve is not to please the sitting president or ensure a specific political party wins the next election cycle. Their actual economic mandate is to balance artificial economic growth with the brutal reality of structural inflation. If the central bank simply caves to political pressure and prints endless amounts of paper currency to lower interest rates, it creates an immediate illusion of wealth. But that exact behavior simultaneously triggers a massive hidden tax on the working class by eroding the purchasing power of every single dollar in existence. Every single unnecessary dollar you spend on stupid consumer items is a loyal worker you just fired from your wealth-building army. Whether or not the central bank has actually done a competent job of managing this balance throughout history is a topic for a completely separate video. But that exact dynamic is why Kevin Warsh is heavily emphasizing the absolute necessity of institutional independence right now. For the past year, it seemed to many institutional analysts that the central bank was on the verge of losing its autonomy entirely to the executive branch. While it is certainly too early to make a definitive judgment on how this administration will interact with the new chair, these structural concerns are completely valid. You need to pay incredibly close attention to the public statements coming from Kevin Warsh right now. If you can accurately understand the mathematical mechanics of how the central bank manipulates money, you can accurately predict where global capital is going to move. The Federal Reserve holds total dominion over the global reserve currency, which means their internal policy choices dictate the price of your mortgage, your car loan, and your index funds. Let us break down the exact mathematical mismatch between what the new chairman wants versus what the White House is demanding. During his intense confirmation hearings, Warsh explicitly stated that the president has never once asked him to predetermine, fix, or commit to any interest rate decision. That is an incredibly strategic and carefully phrased legal statement for him to deliver to the public. If you have been watching the financial headlines over the past year, you know that the administration has been relentlessly demanding drastic interest rate reductions. The political leadership has publicly argued that the central bank should slash borrowing costs to baseline levels to aggressively stimulate domestic manufacturing. They want lower rates, so regular consumers can easily buy expensive homes and cars on cheap credit, which artificially boosts gross domestic product. They want lower rates so massive Wall Street corporations can borrow billions of dollars for next to nothing and use that cheap capital to buy back their own stock. And most importantly, the federal government is currently sitting on a staggering $39 trillion mountain of national debt. This national debt is currently growing at an exponential pace. Not just because the government keeps spending money it does not have, but because the interest rate on that debt has climbed significantly. As older government bonds mature, the Treasury is forced to refinance trillions of dollars at these new higher market yields. This means the absolute fastest growing expense for the United States government is no longer the military or social programs. The fastest growing expense is the literal interest payment on our past national debt, which is rapidly crowding out the rest of the federal budget. Slashing interest rates would allow the Treasury Department to refinance that massive $39 trillion burden at a massive discount, saving billions in taxpayers' cash. The administration has repeatedly implied that they selected Warsh specifically because they believed he would cooperate with this low-rate strategy. But the moment he officially takes the driver's seat, we are seeing an immediate deviation from that exact narrative. The structural reason this policy friction matters to your net worth is that artificial interest rate cuts always carry severe inflationary consequences. Think about this scenario through the lens of basic human psychology and market supply and demand. If the central bank aggressively dropped mortgage interest rates back down to 4% tomorrow morning, a massive wave of buyers would instantly rush into the housing market. Because the total supply of available homes remains incredibly tight, that sudden surge of cheap credit would trigger massive bidding wars in every neighborhood. Those bidding wars would immediately drive residential home prices significantly higher, which makes the underlying inflation problem worse for the average family. We are already confronting a severe structural inflation problem in the modern economy that has nothing to do with standard textbook models. Even before the sudden and intense military conflicts broke out in the Middle East, consumer prices were already accelerating upward. The moment geopolitical tensions caused regional disruptions, crude oil prices shot straight past $100 a barrel on the global market. Higher oil prices do not just mean that you are forced to pay a higher price at the local gas pump. A massive spike in crude oil flows directly through every single layer of the domestic agricultural and shipping economy. It immediately drives up the cost of diesel fuel, which means it becomes vastly more expensive to transport groceries to your local supermarket. It drives up the cost of industrial fertilizers, which means the baseline expense of producing food spikes significantly for regular farmers. This structural inflation is growing at a pace that completely outruns the average person's annual wage growth. This is not a temporary trend, because modern inflation is explicitly outpacing the purchasing power of standard middle-class salaries. If Kevin Warsh decides to completely capitulate to the political narrative and aggressively print money, it would be fantastic for asset owners in the short term. Your paper portfolio of stocks and real estate would immediately shoot higher on the screen, but it would be an absolute disaster for the long-term stability of the United States dollar as a reliable store of value. Warsh is currently indicating that he wants to take a highly disciplined wait-and-see approach before committing to any premature rate cuts. Furthermore, he has explicitly pledged to protect the traditional separation of church and state between the central bank and the political apparatus. A few months ago, the idea was floated that the central bank should directly consult with the executive branch on all major monetary decisions. Warsh has essentially shut that concept down by reiterating his commitment to an objective, data-dependent model of governance. He also dropped a highly cryptic phrase during his official testimony stating that we need to see a total regime change in the conduct of monetary policy. He intentionally left the specific operational details of that phrase entirely unexplained to the public. Is he referring to a structural change in how the central bank communicates its future interest rate projections to Wall Street? Is he implying that the Federal Reserve needs to aggressively shrink its massive multi-trillion-dollar balance sheet to drain excess liquidity from the system? This level of institutional uncertainty is exactly why markets are experiencing massive intraday volatility right now. At the end of the day, it does not actually matter what individual rhetoric comes out of the White House or from the chairman's mouth. What truly matters is the mathematical reality of how the Federal Reserve governors actually vote on policy choices. The chairman does not possess dictatorial power to single-handedly set the target interest rate of the United States. Every single policy adjustment requires a clear majority vote across the 12 active members of the Federal Open Market Committee. This means if Kevin Warsh wants to either raise or lower interest rates, he must successfully convince at least 7 independent voting members to agree with his logic. This brings us to one of the most unusual institutional power struggles in the history of modern finance. The previous chairman, Jerome Powell, faced an immense amount of political hostility for keeping interest rates elevated to fight sticky inflation. The tension became so severe that a formal federal investigation was launched into his past management of internal central bank building renovations. Jerome Powell's official 4-year term as chairman officially expired on May 15th, and he agreed to step down from the leadership seat. But in an absolute unprecedented historical move, Powell announced that he has zero intention of leaving the Federal Reserve Board of Governors entirely. He intends to retain his individual voting seat on the committee until the ongoing federal investigations are completely resolved. This means that even though Powell is no longer running the press conferences, he remains an incredibly influential voting member inside the room. He will likely use his vote to block any reckless or premature interest rate cuts if he believes the underlying inflation data is still running too hot. Kevin Warsh is entering a highly divided committee where he only commands a single vote among 12 powerful actors. We must also look at Kevin Warsh's past track record to understand his true psychological biases when dealing with a crisis. He previously served as a central bank governor during the chaotic peak of the global financial crisis from 2000 to 2011. During that era, the institution was led by Ben Bernanke, who pioneered the aggressive printing of electronic dollars to fund quantitative easing. The central bank slashed interest rates to absolute zero and flooded the banking system with trillions of dollars of artificial liquidity to prevent a collapse. During those internal policy debates, Kevin Warsh was consistently one of the lone dissenting voices inside the room. He repeatedly argued that the scale of money printing was a massive policy mistake that would eventually trigger severe long-term inflation. He warned that artificially suppressing interest rates for too long would destroy the baseline value of the currency and create massive asset bubbles. This historical record tells us that deep down inside his intellectual core, Warsh is a traditional inflation hawk who favors monetary discipline. This is exactly why Wall Street is completely confused by his appointment right now. If he acts on his true economic beliefs, he will maintain a higher for longer interest rate policy to crush the inflation threat. But that exact choice would cause severe pain across the real estate market and the highly leveraged corporate banking system. Our currency is not backed by physical gold or any tangible precious metal in a vault. It is backed entirely by a collective psychological promise and trust in the legal stability of the United States government. If the public entirely loses faith in that promise due to endless debt expansion and political interference, structural inflation accelerates out of control. To successfully fight inflation, a central bank must do the exact opposite of what politicians want. They must keep interest rates elevated and actively drain digital dollars out of the commercial banking system. The Federal Reserve actually pivoted its strategy back in late 2020 when they got nervous about a minor economic slowdown. They halted their balance sheet reduction program and quietly began injecting liquidity back into the financial system on a monthly basis. Now Kevin Warsh has to make the ultimate decision on what he truly wants to preserve. Is his primary focus going to be saving the long-term value of the dollar or saving the short-term appearance of the stock market? If his true priority is protecting the currency, it means regular consumers must get comfortable with high borrowing costs for the foreseeable future. That means credit card interest rates, auto loans, and home mortgages will remain highly expensive, which slows down consumer demand. On the flip side, the political apparatus wants to see asset prices continue to break record highs to project global economic dominance. But artificially pumping asset valuations without underlying economic productivity simply accelerates the wealth gap and creates hyperinflation. We are already seeing the early signs of global capital losing patience with this endless debt expansion cycle. Major international central banks are systematically reducing their holdings of United States government debt instruments. China has shifted from being a massive net buyer of treasuries to a consistent net seller of American government debt. Japan, which currently stands as the single largest foreign holder of U.S. currency, has significantly reduced its allocation to American treasuries. Global institutions are actively diversifying their massive capital reserves into physical gold at a record-breaking pace. They are making a logical mathematical assessment that paper currencies burdened by $39 trillion of debt will inevitably lose value over time. The true moment of clarity is going to hit the market on June 16th and June 17th. That is the official date of the next major Federal Reserve policy meeting. That will be the literal first time Kevin Warsh is forced to publicly articulate his specific vision and deliver an actual interest rate decision. Until that date arrives, you must ignore the short-term noise on the evening news and stick to a disciplined personal framework. Do not let media sensationalism or political arguments dictate how you handle your hard-earned retirement capital. The individuals who build real lasting wealth do not buy and sell their index funds based on who is sitting in the chairman's office. They focus entirely on the core variables that they can actually control in their daily lives. They keep their personal savings rate incredibly high. They entirely avoid high-interest consumer debt, and they automatically dollar-cost average into high-quality assets. Every single time the market experiences a temporary emotional correction, the undisciplined speculators panic and sell their shares at a massive loss. The patient long-term investors quietly buy those exact shares at a deep mathematical discount because they understand the macro cycle. Take this quiet period before the June meeting to review your personal liquidity and ensure your portfolio is built on a foundation of reality rather than speculation. If you found true value in this macroeconomic breakdown, share this video with a friend or an investor who needs to see the real numbers. Stay boring, stay patient. Peace.